we jump in, a quick reminder that we publish our premium podcast, 19 Minutes, 3 times a month on the 9th, 19th, and 29th. It's a short, focused update designed to help you think ahead and make faster, clearer decisions. You can subscribe using the link in the description. Thanks.
Welcome, everybody, to another episode of the AgView Pitch. We're going into a new marketing week, January 5th through the 9th, actually the first week of 2026. And we have with us Jeff Fichtelman to bring out the new year. How's it going, Jeff?
Well, it's going well. I feel like we've started and really ended the year with a whimper and really kind of a depressing move in beans. Obviously, it took till the last hour to get the Farmbridge payment amounts out. I'm starting to really question if they were going to hit their deadline of the end of 25 to at least state the amounts.
Mm-hmm.
And so, I mean, it mixed emotions, to say the least, on kind of the state of the grain markets now, which obviously we could talk about.
Mm-hmm. That's kind of surprised. You know, you look at that dollar amount before we dive into the markets, but you look at that bridge payment dollar amount, and it's more for corn. And I understand sort of how they did the math, but you know, the corn didn't need more of a payment. The beans needed more of a payment, and $30 or whatever isn't even a patch, anywhere close to a patch, because a lot of the guys we see, you know, when we look at that amount difference or that deficit that's there due to a whole bunch of things, tariffs being one of them, is a hell of a lot more than $30. I mean, it's 4 times that amount or so, you know, and I'm not complaining. I mean, a little bit's a good thing and too much is a bad thing as well, you know, because I think any dollar amount we get there gets 70% of it gets sucked into the rest of the economy anyway and leaves the farmer's hands pretty fast anyway. But it's just interesting how the math gets done in some of those processes, I guess.
Yeah, obviously the quote unquote soybean farmer was the public display of why they're doing this.
Mm-hmm.
It does feel like, and I want to believe the government came to these numbers in their own mathematical way, but honestly, I can't remember the CPA's name who put out that article trying to project. Yeah, Sneefer.
Yeah.
It almost feels like the government just copy and pasted his numbers, because he was nearly spot on across the board. And
I've worked with Paul for a lot of years. He's really good with math. We'll put it that way.
Yeah. Clearly, kudos to him. And obviously, his approach, of course, was to take the spring ECAP payments and effectively say we got roughly 10% more. And at the time, of course, corn got a little more out of it. I think the coincidence of soybeans were obviously ground zero of China not buying, but then to say they're going to do the bridge payment and then within a week or two coming to a version of an agreement with China, and then seeing China buy, and of course seeing the bean market rally, it's given up most or all of that rally. But at the time, I'm sure they're like, hey, we kind of solved soybeans. Corn didn't really go anywhere, and you hope, obviously, most farmers tend to be roughly 50-50 and maybe making arguments in one pocket out the other versus the guys who perhaps do swing more heavily one way or another. Obviously, depending on which side they swung, got the short end of the stick here. So, yeah, it was disheartening, but I think guys are used to the government letting them down.
Yeah, and, you know, we really don't want money from the government anyway. We'd prefer to have something happen to commodity prices or just some sort of an adjustment on the cost side. I just got done working with a really intelligent, very business-minded operations from South Dakota here today, and the outlook's, you know, at best, if the yields are really good and everything goes just perfect, and you know, and you throw in the bridge payment that's technically, you know, comes in 2026. We threw that bridge payment in there, and then we were factoring in some money on PLC in his situation because he was in a county that yielded lower versus the rest of the county, just because he was in an area that didn't get rain. And so now he's probably hoping it's hopefully going to be a PLC payment. He's probably not going to get an ARC like some counties will. But you throw in those estimates and you still are lucky to have a break-even year. You know, we need something to give. We either need some price improvement or we need some cost reduction or some piece of both of those. And I think it's just, you know, it looks to me like, you know, we probably got another year or two of trying to tread water here at best, hopefully, and do what we need to do. Control the controllables. That was kind of was his request today. It's like, what are the controllables that we can do and manage? And I think those are the key things. But I want to ask you a question too, and I want to shift gears here for a minute. We just left 2025. This is the first week of 2026. What was one of the best, and I didn't forewarn you on this question, so what was one of the best lessons or challenges of last year that is a lesson for 2026 that can be applied in your opinion? Is there like any one thing, or is there like a theme of this is something that we should take out of 25 and apply in 26?
I think the lesson is actually, in my opinion, been more of a recurring lesson over the last 3 to 5 years, really the last 8, is that as a farming population in the US, we've gotten incredibly good at growing this crop. The seed companies have gotten really good at making it resilient to certain weather patterns. And all of that has and maybe one last key factor, which is not necessarily tied to our ability to produce the crop, but the USDA is in a trend of using the trend line yield, which feels like it's high every year. And it all kind of comes to a head without summer rallies. I feel like the market is waking up to the difficulty to kill the crop despite windows of dryness and heat and concern. It feels like we just are not getting the summer rallies that we used to. And I also think a lot of guys, it feels like a recurring conversation I had this fall was I really don't know how it ended up as good as it was. Now, it was not record, but many farmers are quick to obviously be conservative with where they think production will be. And it felt like we finished this fall with a pleasant surprise, but not a record in many areas. And I think the floor has been raised on the corn yield. I also think the USDA is way overstating the ceiling being raised, but it creates an environment where year after year we keep getting to January's crop report with simply an overstated production. I mean, last year they had to drop corn yields. I can't remember the exact amount, around 4 bushels. And also during the Jan-Feb window is South America's key summer months. And their crop is also resilient, but marginally less resilient than ours. So it feels like we have to shift as a population. And maybe this is like the famous last words, but to really focus our marketing in the winter time, both for the stuff that's going in the bin, but also looking ahead to 26. But it's tough. We're in a world where the opportunities feel like they're small and fleeting. But I do want to bring up a key point on. So it feels like right now the government has levers they could pull. We could go to E15. We could put more money into supporting the crush industry or renewable biodiesel. Obviously, more trade agreements, but that seems tough. But there is levers we can pull domestically. The conundrum, though, is probably the most front of mind political statement you hear all the time is the inflation, the cost of inflation. And I remember there was one time Trump kind of talked out of both sides of his mouth during an interview when he was
Weird. I've
talking about,
never heard him do that, but
yeah, yeah, he's obviously pretty concise usually. But he was talking, he's like, I love the farmers. I want to support the farmers, but gosh, I also need the price of groceries to stay low. And effectively, what he was saying, he's like, the conundrum for the government is by pulling the levers to increase demand, it's going to increase prices and therefore inflation at a time where that's the most politically relevant point
mhm.
to get
Yeah.
elected. And I think we might be entering a world where, consciously or not, you might realize that paying the farmer to bridge the gap may be better than uh, creating the demand, which is not what we want. And I hope that that isn't long term.
Mhm.
Yeah, a lot
So,
of thoughts there.
so you pointed out a whole bunch of lessons from 25, and I'm going to pick on you here.
Yeah,
Any suggestions on and that's the hard part of the,
yeah,
part one and part two of the question. Part one was, really, our rallies are limited in the summer. We are tending to be able to produce our way out of about any kind of weather event. The market thinks if we have a shitty weather situation, we're going to grow a big crop anyway, and so you can't kill the crop. And then I don't know. I guess those were kind of the main bullet
Yeah.
points. How do we manage that? As a farmer, I mean, is it just as simple as having targets in place and playing the government games to our best of our ability, or what are the lessons from that? I mean, because I keep coming back to it's like,
What do we do?
yeah, what the hell do we need to do here? I mean, we're pulling
Yeah.
like every freaking lever we have, it feels like. And, in cost of production is the lowest, is the smallest of the three levers. The biggest lever is you pull is maximize your yield, because that lowers your cost of production. The second lever you pull is, marketing, which do a decent job of marketing. And that's where I'm going with you. And then that last one's trying to save money. But I think we got to be super careful. I say this all the time as a broken record, but don't cut costs on things that either enhance or protect yield, because that affects your cost of production. So back to the marketing piece, is it just as simple as making sure we have targets in there and pulling the trigger and selling small incremental amounts, or what is it?
Well, this is, yeah, I mean, you nailed it. You summarized it well. This has been the message of the year for me to the guys that I get to work with, is twofold. One, I think a lot of farmers incur a lot of fees that maybe they don't realize, and they certainly shouldn't be doing. For example, delayed price being a popular one. We live in a world where the harvest price really is not appealing. Well, grain companies love a program called delay price or price later, where of course they charge you to take the grain but not price it. And those fees just creep up so fast. Of course, setting basis and waiting, then all the roll fees and all these. There's a lot of programs out there where they charge a lot of fees, and we have to enter a world where we simplify our marketing in a major way, which is, let's pick values, especially cash values, and when it's good enough, and obviously that is a key term, and a lot depends on the ability to make money. Not a lot, but let's shoot modestly and try and yield our way to more interesting levels profitability wise, but find a number and sell 10%. And because the other problem I see that kills guys is when they get those decent opportunities, I can't even call them good, when they're decent, we never sell enough. And we always look back and kind of kick ourselves, say, man, why didn't I do more at that number? So it's so easy, I think, to get in the trap, a legitimate trap of, when the market's been so bad for so long and the profitability is not there, and we only get a small rally in the market, we want more out of that rally. And therefore, we're more inclined to want to wait or not sell very much. But feels like the lesson has to be learned that every stinking rally fails less than we think, or is so short. So let's make sure that we sell enough, 10, 20%. Obviously depends on your situation and where we're at in the crop year. But yeah, it feels like we're in a world where the cost levers are very tough to pull down. The marketing, of course, I think it's a game of minimizing unnecessary fees, collect a series of small wins. One thing that always sticks in my mind is, I think it was a book or a podcast, I can't remember, but somebody brought up a statistic. I think we might have even said this on a podcast one time, Chris, where everybody knows like 9 out of 10 businesses fail. But one guy looked at businesses that started during recessions versus those who started during boom times. And during recessions, like 3 or 4 times the amount of businesses actually succeeded versus boom times. And it's because people have to be hyper focused on every little thing to maximize efficiency, obviously minimize cost, stuff like that. And I think seeing this moment, as hard as it is, as an opportunity to, like, okay, how do we get really efficient in our shop, clean up all the waste, be very focused on minimizing costs, that when we do have good times again, we'll be banking a lot more money out of it. But there is no easy answer, really.
Well, I wrote down your answers, and I'm going to see if I took the appropriate notes. Okay. Because because I really want people to think about this, because it doesn't have to be complicated. Right. And this is one of the things I wanted to get out of you. I was bragging you up to the client that was just here. I was like, this Jeff guy is really smart. He thinks about not just the marketing plan, but he thinks about the business portion of it. And that's why I wanted to have this conversation with you going into the beginning of the year. And, your challenges or some of the things, lessons from 25 again, to highlight those again was, these summer rallies are limited. They don't last long if they even show up at all. And, the market sees, a weather issue and half-ass believes it or doesn't believe it at all. And so your rally is limited from that. Another one I'd throw in there too is farmers are slow to sell. And then when we do get a rally and they sell, it starts putting a wet blanket on how high up we can go in the first place because of the sales of the inventory heaviness that's out there. And then your other comments too is, just the market, thinks that we're going to grow a big crop no matter what anyway, in the end. And so that limits it. So your lessons, and I like this, the first one that you said was simplify your marketing. So just stop trying to overcomplicate things does not fix anything. Cause I think we keep looking for like, what do we got to do here? And it'd be easy to overcomplicate it. So simplify it. Pick your price and pull the trigger. I like to say, pick your margin target and pull the trigger, which is essentially the same thing. It's just, know your cost of production, correlate it to the price. Is there a margin? And that margin doesn't have to necessarily be profitable either. Unfortunately, I hate saying that, but it's like, are you limiting your losses? Because there's some cash flows. We've been putting some budgets together that look pretty damn ugly going into 26. So do you limit the pressure or do you wait too long? And so I think it's managing that. And then I really like the one you said about, selling in increments of percentages like 5, 10, you said 10%, but even a 5% sale is better than nothing, and know what those percentages are. Cause I think just to add to that one for you is I think sometimes there's still some operations that are up in the air a little bit on their rotation. Dial it in kind of pretty close to what you think you're going to plant so that you know what your percentages of sales are. Because if you shift your corn, bean, or wheat or whatever crops you're growing ratios a little bit, that changes how much you should be selling of one crop versus another. And then the last one you said is don't get too bullish in a rally. In other words, be realistic about, how much could we get out of this? I kind of paraphrase in your last one there, but any
Maybe
other things?
Well, on that last point, I would say talking in those general terms, don't get too bullish. It's hard to know, like, how does that translate? Always make sure you sell at least something and make it modest size, 5, 10%. I like to remind guys now, anytime they say this price is decent, but not good, decent is good enough for me now. We got to sell. Like,
Right.
we can't wait for a quote unquote good price, because even if it's there for a day or two. And we probably don't realize it's good until months later, and we look back at the chart and say that was good because at the time it was simply decent. Obviously, the rally in beans recently stings for a lot of guys who didn't do enough. Anything with an 11 in front of it was quote unquote decent for a lot of guys. They felt like, hey, that was a pretty good price, but it wasn't 12 something. And of course, it was there for such a short window of time. So I always challenge guys like, and this isn't an admittance of defeat. Actually, I quite recall an interview or a podcast with your business partner. I think his name was Joe. I'm drawing a blank right now. But he had mentioned something that really stuck in the back of my mind, which is like, I think he said his dad told him one time, farming is about being on a ladder, and that there's many years where you don't go up a ladder, you don't go up a rung, but your goal is not to go back a rung. That you just wait patiently for that opportunity to advance 1, 2, 3 rungs. And this feels like a moment in time where the goal, of course, is not to move backwards. The hard thing about that point of view is like, when on the horizon is it going to be optimistic again? And I think if we enter a world where, just think a big picture, the market will still provide quote unquote decent prices that are probably break even or a little better with decent yields a few times a year, maybe more. And if you're a low cost producer, you'll obviously find better value in that. But to your point, Chris, like, if we are disciplined and do low cost marketing, at decent values, enough times to make an impact, to pull the levers of the government programs. Like, I know we don't like it, but it's money and it matters. Pull those levers when we can. The big beautiful bill made crop insurance really cheap. So don't blindly do the same thing you always do. Talk to your agent and challenge them to really look at what programs are the most effective. The government keeps cheapening this ECO and SCO. So make sure that we're capturing all the value that's out there. It would be nice if the government made it a lot more simple, and said, hey, we're just going to turn on E15, put 2 billion more ethanol demand for corn, and market goes up to 550. But that's just not the game we're playing in. So we
Mhm.
have to pull all these little levers, pick up all the dimes and quarters and nickels to add enough value to make this work.
Yeah, no, that's all really good, and I would wholeheartedly agree on the insurance side of things. You know, we've been given a gift that's pretty invisible on the insurance side of things, and
Yeah.
on the risk mitigation level of protection that a lot of us have, and that was one of the things we were looking at today. Is the risk mitigation. The odds of losing as much as a person could have lost last year is significantly improved by virtue of some of the safety nets that have been built into the insurance programs and some of the other elements of the big beautiful bill that kind of shore some things up for us a little bit to kind of help us be a little bit more sustainable or whatever. And back to
Yeah.
your ladder analogy, that was Joe Paulson, and his dad,
Yeah.
Mike Paulson, is a really wise guy. So I want to make sure they get credit where credit's due, because
Yes.
that was right. That
Yeah.
Mike always has a lot of really good analogies and has a lot of experience. And I think that's the other thing for lessons. I think is those of us who are fortunate enough yet to have our dads around, that have been through some of these challenging times, is having conversations with those who have been through some of these things and say, hey, what am I not doing here? What am I not seeing here? What's a controllable that I'm not, a lever that I'm not grabbing on the controllable side? And I think that's really a key thing. I want a couple more key things and we'll wrap this up, Jeff, but I want to, from a practical standpoint and from a more short term question here, we're going to see a report here
Mm.
coming up next week. Is there anything that farmers need to be thinking of short term here? There's a lot of grain unsold. There's a lot of things that farmers need to do to be thinking about this old crop, but also the new crop as it relates. Any insight or things guys need to be paying attention to? Because I keep getting asked the question, what's going to happen to this corn yield? And I think Iowa's a little high, is my opinion.
Yeah.
But I don't
Yeah.
know about the national thing. What's your perspective, and what are some things that you watch or that you think farmers should be watching for as that report
Yeah. It
gets
feels
closer?
like probably the most likely outcome is they do lower yield, but it's probably at a disappointing number. And the market maybe doesn't get the rally that everybody so badly wants. Um, I have optimism that the funds have sold a majority of their bean length, so it's a much cleaner market. And at the same time, they've actually gone short corn, which, coming into a report where everybody needs it to be bullish, you really don't want the funds long, because then it's like we're all on the same side of the boat. So the fact that they've actually tried to play their hand on the short side of corn is interesting. Now, on both corn and beans, they have more to sell if the story is not there. So there is a lot riding on this. And that's why, like, we're going through each farm family and just looking at, okay, what's cash flow needs, marketing position, and make sure that we're not too exposed. This is a report for you got to play the balance game. Like, have enough sold that you're covered your bills. And even though that may miss out, let's say we do get a bullish report and you're kicking yourself, why did I sell 5 days before the report when I could have waited? The far greater risk of a farm operation is not missed opportunity. It's watching that thing get crushed lower and we didn't do enough. So it's a coin flip on how the USDA is going to take it. I think a lot of logic points to them needing to lower yields. And I do think the market will at least bounce a little bit. The problem is there's a lot of guys ready to sell that
Hmm.
rally,
Yeah.
which makes those rallies hard to sustain.
Hmm.
Um, so it again, we just need to play the game of good enough, and execute and survive. And I heard recently there was one podcast I was listening to, and although the general economy is not really in a quote unquote recession, but he had brought up a point. He's like, he tells everybody never waste a crisis. And the premise is like in crisis mode, we become hyper focused as a people, and we really zero in on like, hey, how do we get out of this crisis? And a lot of times we become way better business owners,
Mm-hmm.
way better in this case marketers, maybe farmers. How do we really take advantage of the moment and force ourselves to learn when times are super easy? It's easy to get complacent, sometimes sloppy with your finances. So let's try to see the glass half full here and say, okay, the market is not enjoyable, but let's take advantage and force ourselves to be better at this game.
Mm-hmm. So from a practical standpoint, if I'm farmer A and B listening to you here, or C and D and E and F farmer listening to you, depending on how much you got left to sell, because everybody's gonna have different amounts and different things,
Yeah.
but having some targets in pre that, so if we do get a rally, they hit, if they blow through it, then they'll be pissed that, wow, damn, I wish I wouldn't, but,
Yeah,
but,
yeah.
those are activities to make sales, and then maybe do a little bit on the front end, like you said, and kind of split is that kind of what your thought
Yeah, I
is
would
that
say,
is?
I mean, obviously, I always hate generalizing percentages because everybody is
Right.
in a different position, but
Yep. Get it.
um, assume a guy has storage and therefore bushels are in the bin. He's not paying DP or something like that. If he's paying DP, just close your eyes and price it,
Yeah.
uh,
Agreed.
and get up to the point at which, like, I tell a lot of my guys, we need to be at least half, if not two-thirds sold in corn. And we can gamble with, say, the last 25 or 33% in terms of riding the wave and hoping for the best on this report. But I don't even mind locking in basis for, say, Jan or Feb delivery, and then working futures offers against March, anywhere from 445 to 465. Because my fear is if this report happens to be bullish, and if farmers all call up and say, hey, I'm ready to sell, his basis will
It's gonna
fall off.
go. Yeah.
So let's at least talk to our local grain buyer and say, hey, what's the best basis as we enter this key window of cash flow needs? Now, if you're a
Mm-hmm.
farmer that you've sold 75%, you've covered your bills, you had a decent yield, and you don't mind waiting through the quote unquote storm of possibly the next 30 to 60 days. Now, if the report's bullish, sell it. But if, let's just say, it's neutral or something like that, um, I don't mind waiting till springtime because you almost always get a story at some point. But
Mm-hmm.
that is a rare circumstance where a guy feels like he's in a comfortable position and has the last 20 or 25% left.
Well, and
But
unfortunately, in this year, there's a lot of people with 75% sold and still aren't whole
I
yet.
know,
I
yeah,
mean, so you still gotta. It's like this whole thing that one of my lessons from 2025 was just emphasizing the cost of carry, not just capturing carry, but you know, to capture carry, you hardly ever get enough carry to justify holding on to it if you're in a position where you got to have 95% of your crop sold to cover your line of credit or whatever it is. It's amazing the amount of people that are that have burned through enough working capital that maybe weren't borrowing money 3 years ago that are borrowing money now that have burned
yeah,
through so much that we got to market differently. To your point, I mean, we got to be more aggressive, turn that cash over because it's costing us to sit on this inventory. And even if you're sitting on cash, it's still costing you. You could put it in money markets or whatever. Last question I have for you is, you talked about the 25 and getting that sold. Do you pair some 26 sales up with the 25, or what's your thought on that? Or on the 26, do you pair some of these 26 opportunities up with that? And to what degree makes you feel comfortable if you put your farmer hat on the
yeah,
26?
yeah. I mean, I like being a quarter sold. I mean, as I kind of
Yeah, I
preached
do too.
earlier, seems like some of the best opportunities are December, January, February. So if you're starting at zero, that doesn't mean sell 25% today. It means sell maybe 10 and work some offers up to 470. But it feels like we've entered a world, and as a lot of people recall in the 20 teens, 350 to 450 and call it 9 to 1050 was the price range for what felt like many years. And 4 and 10 was like the magic number for a lot of farmers. They felt like they could make it work. And I know a lot of guys are like 5 and 12 now,
Mhm.
but it seems like the market's really willing to reward maybe 470 to 475 and call it 1075 to 1150. So that's why we got to shift that kind of mindset a little bit. And if we find ourselves where those numbers simply don't work, um, I've been challenging a lot of guys too to really be critical of each farm that they're renting and look at the rent agreement and say, does it make sense? And that's a really hard thing to do, and probably takes someone like you to help with the spreadsheet you guys have built.
Mm-hmm.
But during those boom times, there's a lot of guys that got into some farm rent agreements that are just really not good. They share too much of the revenue and none of the cost. And obviously you can counter argue by saying, hey, you're spreading equipment costs over more acres. That's an important factor. But I don't know. There's a lot of things we got into that possibly may make sense to walk away from. But again,
Mm-hmm.
that's a rare circumstance. So
Yeah. Well, and there's a lot of merit there. I think, like you said, it's every single situation needs to be looked at. The observation I have currently right now that we've heard from a lot of our clients is the opportunities that are coming out, you know, opportunity to rent 500 here, 400 there, 1,300 here at a time in one lump sum. Well, that's telling you that some people are letting some stuff go. But then again,
yeah,
like you said, you know, okay, what does that look like in terms of how much is the rent? Is that justifiable? And at the same time, you know, you do, like you said, you know, you do need to look at that contribution margin of, you know, okay, where are we spreading? How is that helping us to spread our fixed costs? Do we have to spend any money to do that? Or can we just, you know,
yeah,
can we just add it and do it? A lot of people have a tendency to have more machinery than they need. And so it does, assuming to your point that the rent number is at the right level. So I guess
yeah.
this, you know, I want to kind of wrap up here. Is there anything that I didn't ask I should have brought up, or what do you want to leave growers with as they go into 2026? Give you the last word.
No, I think we hit on it. Obviously, just a zeroed in focus on running the most efficient business you can. Focus on the fact that it is a business and the really deep down understanding of cost, and then simplify the marketing because there's a direct relationship between the more simple it is, the less fees get accrued, um, and kind of accept a decent price because a decent price with a good yield and a well-oiled machine where it's you're running
Mhm.
cost efficient, no fees. I think we can make it work, especially with the government levers that'll get pulled. So
Mhm. Awesome. If people want to reach out to you and get a hold of you, I mean, they can tell by the conversation we just had that you look at this marketing thing holistically, not just from the marketing side, but if they want to get with you and talk strategy, here's my
Mhm.
situation, here's my specific thing that I got going on. What's the best way to reach you to have a conversation around some of those things?
Yeah, I would say the easiest actually is just go to our website, interactiveag.com, and just do the contact us because that goes directly to my email.
Okay.
And because my email with my long, confusing name makes it harder. So that's probably easier,
I'm still
interactiveag.com.
trying
And
to figure out how to pronounce it. I think I've got it down pretty good.
yeah,
Fichtelman, is that right?
that's right. Yeah. Even it took
Okay.
my wife forever. So
Yeah,
we'll get there.
well,
Yeah.
that's good. All right. Well, cool.
All
I'll
right.
make sure Mac has the website in the show notes there too. So if people want to
All right.
click on that and reach out, they can. So Jeff, thanks a lot. Really
Yeah.
appreciate it. We'll get you back here again a couple weeks after the report, and we'll see how the dust settles, and we'll go from there.
All right. Sounds good.
All
Take
right.
care.
Yep. Thanks, Jeff, and thanks everybody for listening. We'll catch you again next time on the Agview Pitch.